Okay, let's match these terms up. The information system that measures business activities, processes that information into reports, and communicates the results to decision makers. That is the activity of accounting. Licensed professional accountants who serve the general public. So they're licensed professionals. They can kind of go wherever they want. They're just hybrid accountants. That is certified public accountants. Any person or business to whom a business owes money. That would be a creditor. The field of accounting that focuses on providing information for internal decision makers. That would be managerial accounting. Certified professionals who work for a single company. So they're not really that hybrid, completely independent accountant. This would be a certified management accountant. And finally, the field of accounting that focuses on providing information for external decision makers like investors, people deciding whether or not they want to loan money to a business. That is financial accounting. Which of the following is not an external user of a business's financial information? Taxing authorities definitely use financial statements. Investors, absolutely. Employees, no, that's not an external user. Customers, absolutely, they'll take a look at a business's financial standing. So the answer would be C, an employee. Okay, let's match up these terms. Oversees the creation and governance of accounting standards in the United States. So just oversees, it's not the actual standards, but it oversees the creation and governance of those standards. That would be the Financial Accounting Standards Board. Okay. Requires an organization to be a separate economic unit. That would be the economic entity assumption. So, everything, it's like you can draw everything's in a black box. A company is in its own box. It's independent from things outside. Oversees U.S. financial markets. So this isn't overseeing the creation and governance of accounting standards. It's overseeing all of the financial markets in general, everything related to financial markets in the United States. That would be the SEC, the Securities and Exchange Commission. States that acquired assets and services should be recorded at their actual cost. So their receipt cost, it's recorded at the cost you actually paid. That would be the cost principle. Creates international financial reporting standards. So not the FASBA, but the ISBA. It's just the same thing as FASBA, but this is for international. The main U.S. accounting rule book. So this is GAAP, General Accepted Accounting Principles. This is created by FASBA. The creation and governance of accounting standards in the United States oversees this. So naturally, FASBA must create GAAP, the main U.S. accounting rule book. Assumes that an entity will remain in operation for the foreseeable future. The going concern assumption. So you're not going to buy an asset that's, a truck that's going to last you 10 years and then think, well, hey, what if we go out of business in 5 years? You're not going to think about that as an accountant. You're going to assume this truck will last us 10 years. Assumes that items on the financial statements are recorded in a monetary unit. The monetary unit assumption, you could match that up. And I don't really understand exactly how this works. It's like, I guess the dollar is very stable, but if you're in the United States if you're in the United States, you're not going to, you recorded something at its historical cost 10 years ago. Maybe the dollar has lost value over 10 years. You don't think about that. You just, whatever you record what that truck cost 10 years ago. Okay. Requires information to be complete, neutral, and free from material error. Faithful representation. Generally accepted accounting principles, GAAP, are currently formulated by this is the U.S. GAAP is the U.S. accounting rule book. So naturally, this rule book would be formulated by the organization that oversees, all the creation of all the accounting standards in the United States. This is FASBA, Financial Accounting Standards Board. Which type of business organization is owned by only one owner? Well, can't be a partnership. That's at least two owners. Corporation, well, no, that's, you're selling a bunch of shares of stock to people. Well, or at least you're dividing up stock between either the public or a bunch of people. So obviously it can't be D. So this is a sole proprietorship. Which of the following characteristics best describes a corporation? Not a separate taxable entity. No, it is definitely separate taxable entity. Stockholders not personally liable for the entity's debts. That's true. Let's check the rest. Is not taxed. No, it's taxed. A business with a single owner. Absolutely not. So the correct answer is B. So, okay, given these account balances, let's solve for common stock. First, let's write out our accounting equation. Assets are equal to liabilities plus equity. So remember, all this equation is saying, if you go drive around town, any business in the whole world, at any moment in time, this equation must hold true. The reason is because all it's saying is that if you took all of the assets of that business, so everything that it has control of, everything of value that it has control of, that it's using to run the business, okay, all of that value is claimed by two entities. First would be the liabilities. So if the business would all of a sudden go out of business and sell off all of its assets, then all that money would first be given to the creditors. They would pay off all their creditors, and then the rest they would just keep for themselves, the equity. They would just distribute it amongst the owners. So creditors, equity, creditors, liabilities, equity, owners. All right. So this particular business here in this problem has $95,945 worth of assets. It owes creditors $1,760, so it has $1,760 worth of liabilities. And then the remaining is claimed by the owners, the equity. So the equity, how do you represent equity in a company? So you represent equity through two areas: common stock and retained earnings. So how much common stock do we have? Let's use pink here. We don't know. We're trying to find how much common stock has been contributed into this company. This pen's not working. Okay. Okay. Yeah. And so common stock just being, so we have a corporation here. It's not like a sole proprietorship or a partnership. So someone, you want to contribute to Walmart, let's say, so you buy $1 million worth of Walmart stock. You're saying, hey, here you go, Walmart. You can go build a new Walmart somewhere using my money. You can go buy assets with my money. So here's my money, but in exchange, give me stock or give me shares or ownership in the company. So this X is how much total external cash has been contributed to the company to date. The rest is retained earnings. Retained earnings just being, okay, so the company ran the business this year and it generated net value. So it performed its operations and it got net income. It created equity. Well, all this created equity that's owned by the owners. You contribute $1 million to Walmart. Walmart makes a bunch of money this year. All right, that's for me. I stake claim to that. So how do you calculate the retained earnings or the amount of money that has remained in the business after the business has performed its operations? Well, okay, intuitively, that will just be the net income minus how much you took out of the business to pay yourself, or AKA the dividends for a corporation. So, let me get a color here. So you first, at this moment in time, to satisfy this accounting equation, well, the dividends is leaving the business. So you put a negative sign in front of dividends, negative 15,320. Add into that the net income. So just subtract revenues minus expenses. That's the net income. Revenues, you had $53,450 worth of revenues. And you had $23,456 worth of expenses. Okay, so now I'm gonna fast forward and crunch some numbers. So there we go. To date, the company or the corporation has received $79,511 worth of investment money from external contributors in exchange for ownership or stock.